There's one other element that we want to get into now, and that's you've built your business, you've got your clients, you've got something that is really of value. How do you value your business? And how do you create a business that can be sold, actually? Wouldn't that be a wonderful thing, to actually sell your business at some point and be able to retire on what you make? Anyway, Peter's going to help us with that. Peter from Sunbelt Advisors. Make sure we've got.
Oops, okay, hold on. Well, while David's doing that, I'm Peter Coleman. I'm the managing partner with Sunbelt Business Advisors and Brokers here in Las Vegas. I've been with Sunbelt for over 20 years now. I started as a child. It might seem somewhat strange to be talking about exiting your business. I'm also a certified exit planner, but exiting your business when you're just beginning it. But it's all about, as we've heard earlier, about setting something up correctly in structure and having a goal at the end of things. People sell their businesses for all sorts of different reasons. One of the most obvious reasons that people sell their business is basically because they want to retire. Other times, I don't like hearing the term when people come to me and say, well, I'm just burnt out. Because that really, people get bored with life. The average, they do equate this owning a business, growing a business, to being in a marriage. After 7 years, you get that itch to move on. You sometimes deal with what I call serial entrepreneurs. They can't stop themselves from starting businesses. But generally speaking, most people need to sell their business when they retire because that's where their retirement is. And if it's not set up properly, and this, as David's already said, this is very high-level view, and we'll be talking over the following months in much more detail about these things. But people sell their businesses most often because there is no succession plan. They haven't thought about, well, what comes next? They've got no one to give it to. They can't really give it to kids, or they can't really give it to employees or let employees take it over, because most times the kids or the employees don't have any money. And people come to me and they want to do this and they want to sell their business now. But the reality of it is, it takes 3 to 5 years to really set yourself up properly. But if you do really get set up properly over 3 to 5 years, there is a way of getting funding for a business to give it to your children, getting funding for a business to let your employees take it over. But you can't just do it in 5 minutes, 5 months, more like 5 years. It's all got to be set up properly. Oftentimes, and I've got to say this, this isn't in a sexist way, women are much more realistic, mothers are much more realistic about the abilities of their children than fathers are. Oftentimes I'll go into a business, you're at your mom and pop business running, and the kids are working in the business, they say we want to sell. My first question always is, well, heck, if this business is so good, why don't you let the kids take over? And it's generally the mother that says, well, our kids are great salesmen, they're great technicians, they're wonderful at what they do, but they couldn't run a business the way their daddy does, and we can't risk them with our retirement. And that's the reality of it. Men want their kids to come and take over the business, but they've educated their kids, they've gone off to college, they're CPAs, they're doctors, they're lawyers. They're not coming back home to run a business, that's for sure. They've got their own business by now. It really isn't a question of when you if you let go of the business. No one's going to live forever. It's really how you're going to let go of the business, how you're going to maximize the value. When is it going to happen? Who are you going to allow to run your business afterwards, and how are you going to create that value? So are you going to plan something, or are you just going to react? Unfortunately, in our business, we deal with the dismal Ds: death, divorce, disease. Those are 3 big triggers for people selling their business, and generally most people aren't prepared for that. the old-fashioned way. People always ask me, well, how much is my business worth? A business is only worth a multiple of how much money it actually makes. Not how much the sales are, how much money goes to the bottom line. And those multiples, you hear really all over the place, especially CPAs are the worst, because they've been generally trained on what I call big company business. And they give you these ridiculous multiples, which aren't going to apply to 99% of people. You'll see here on the screen there, the bottom layer of the pyramid there, 2 times seller's discretionary earnings. Seller's discretionary earnings is the real money a business makes. We've added back everything the CPAs add back, like the interest, the depreciation, the amortization, and then we've added back everything that you might have run through the business because you could, because you were the owner. I call it trains, planes, and automobiles because I've seen all of those on the corporate tax returns. So we're nothing to do with the business. Most people run their personal vehicles and personal gas and personal insurance and cell phones and all that sort of thing through the business. You'd be surprised how much that adds up. I was once sitting with a client and he ran his wife's family's business. And he bragged to me, he played golf on a different golf course every day. Nice life. And he was wanting to sell the business, and we were going through this exercise to see how much the business really made. And we were going line by line, and we got to the bottom, and I showed it to him, and he said, wow, heck, we can't afford to sell this business, because they expensed everything through the business. And that's a bit of a danger. But you've just really got to understand the multiples for most small businesses are in the 2 to 3 range. Then you're not in the 7 ranges, or you really aren't. Those are public company numbers. I'll give you one analogy in why some so-called professionals make a mistake. We often get people coming in to buy businesses and have got MBAs out the wazoo. Sometimes they are the worst people to buy businesses because business education, for the most part in this country or in most parts of the world, is what I call Wall Street Journal, Financial Times, public company education. When you go to the business school, you learn about public companies. They are totally different from small business. The best analogy, and it's not my analogy, it's an analogy by an old gentleman by the name of Ed Pendarvis. He's still alive. He's the man who founded Sunbelt. If you can cut through that low country Charleston accent and get past his seersucker suit, he gave him a lovely analogy. Big business and small business. Well, it's like ball games, football and baseball. Try playing football under baseball rules. And that's the difference between small business and big business. Small business runs on a totally different way to the way public companies work. Okay. I'm going to go through some of these because I know we're running on time here. You really need this. There's really only 3 or 4 ways you can actually get out of a business once you've got into it. You can close the business down. That gives you 0 value. When people come to me and say, well, I closed my business 3 months ago, how much is it worth? I tell them nothing. People come to us to buy cash flow. They want to buy an existing business. That certainly doesn't, maximize value. When people get sick or die, they're not ready to sell. That's certainly not the best way to get out of a business either. Succession's very interesting. I have a colleague, whenever he's employed, and he's generally dealing with bigger businesses, when the owner wants to put his son in charge of the business, we're talking multi-million-dollar businesses, the first thing he does, he has a psychiatrist on retainer. And he insists that the psychiatrist has a full session with the son and writes a report. And over 50% of those reports, when they come back, my colleague has to tell the seller, I'm sorry, you don't want to be giving this business to your son. Hasn't got the right mental capabilities. There's all sorts of issues going on here. And there's an old saying, one generation makes the money, the next generation spends it. and that's very true. So basically, that's the sort of thing that we're dealing with. I want to give you one more little picture, which I'm sure you all know. This is American business. This is the American economy. 93% of all business, all the economy of the United States is what you all do. It's all small business. You know, the triangle is very small at the top. You know, we're talking, you know, the 5 to 50 million range, you know, maybe 7% of businesses. The big businesses are actually a very small percentage of the American economy. Very small. And in terms of getting value for your business, the further away you are from the center of this circle, the more value you will get for your business. People always come to me and when they want to sell a business, oftentimes they say, well, somebody else in the industry is a good buyer. And I tell them no. An industry buyer is your best and your worst buyer at the same time. It's your best buyer because they'll probably succeed. They won't need much training and transition, but they will pay bottom dollar. They don't need you. They really don't. So the people who will really pay the money are the people who are further away from the center of this circle, the strategic acquirers. What a strategic acquirer is someone who needs what you've got, hasn't got it themselves, but can also save some of the money because a lot of your admin costs will be absorbed by the acquirer. Now, not everybody has a strategic acquirer. Okay, the value of a business obviously depends mainly numerically on cash flow, but there's a lot of other things that go into making a business more valuable. The biggest thing that I see as a negative, therefore a devalue of the business, is if you are the business. You've got to, once you've built a certain amount of volume, get key employees involved so that someone can do that business for you. And so an investor can come in and buy the business from you and leave this manager in charge. But if you are the business, I mean, we've got this, a lot of private equity groups around. Private equity groups won't even look at a business unless there's some middle management there. After the stock market crash, a lot of money came out of the traditional stock market and is still on the sidelines. People haven't gone back into Wall Street in the big way. A lot of the private equity group, people email me, call me three times a week. They used to have a $10 million minimum. They didn't want to look at a business unless it was $10 million. Once the economy started changing, people were calling me, well, we'll take this $1 million deal. Because they needed to be moving their money. They needed to be doing something. But unless you've got management in place, a lot of your value's gone out the window. I don't care how much money you make. I had a guy in Charlotte, very interesting guy. He was Jewish American Mexican. I know it's a very strange combination, but he grew up in Mexico City. His father was actually a psychiatrist from Penn State. And unfortunately, this chap had been kidnapped a couple of times because his father was very wealthy. So he came to the States, got himself a job for a while in Bank of America, hated being an employee because he was a real entrepreneur, built a very, very nice business that made over $1 million a year profit. Could never sell it. He just did so much work. And buyers would look at it and say, well, that's fine, but gosh, I'm going to need to employ 3 people to do what he does. He worked phenomenally hard. So, make your business, you've got to have something to hand on. Your business got to be attractive to people. I can go more in different times into, how to increase the value of your business. It's not on here, but on our website, if you go into tools, there's something called a value builder tool. Anybody can go on there. no more than 15 minutes, very easy questions, and you'll get a score. And that'll give you an idea of how to add value to your business. It's called the Value Builder tool. It's on our website under Tools. I don't want to go too much more into valuation at this point. I think that's for another day. I'd like to thank David and Jazare and the rest of the group, Lorna, for inviting me today. A lot of what I was going to talk about is basically getting very technical, and I don't think we really have time to go into that today. So this is something we'll address in future meetings. That is who we are, Sunbelt Business Advisors. You can see all those little dots. We're all over the country. We're over 200 offices in 29 countries, I believe now. And that's what we do. We help people sell their business.